And my next guest says this is classic decoupling, which could wind up hurting the U.S. and spark retaliation. Joining me now is Stephen Roach, former chairman of Morgan Stanley Asia, and David Riedel, president of Riedel Research Group. Welcome to you both. Stephen, I'll just start with you. It sounds like you're not saying these moves are a bad idea, but just that we shouldn't think they're without risks or consequences.
Well, Kelly, thanks for having me on. U.S. politicians have figured out that decoupling is bad. It raises costs and exacerbates tensions with China. So guess what? They've decided to rename the concept and call it de-risking. Whatever you want to call it, the numbers are very clear. In 2018, at the onset of the trade war, China accounted for 47% of our total merchandise trade deficit, and now the number is 32. So we have decoupled, whether they want to call it that or not. And these actions, along with Mike Gallagher's ill-informed efforts to decouple capital flows, I think will exacerbate problems in the United States and lead to further conflict with China.
David, do you agree?
Well, I think you're quite right. Because of changes in supply chains and trade flows, the trade flows today are very different than they were pre-pandemic. And I think that that's partly political and partly economic. I think the world discovered that they couldn't rely entirely on China for so many of their trade routes and trade linkages. And so that's been diversified. And I think China trying to come out of the pandemic hasn't been able to find its footing because people have found other solutions to their manufacturing. I completely agree on stop cutting off the capital markets connections. I don't think that's a wise move for the U.S. to ignore entirely as an investment option the second largest or maybe the largest economy in the world, depending on how you're measuring it. So
what do you think the impact will be if we, any day now, I think we're expecting this executive order to come down? David?
Well, my view is that the executive order is another brick in the wall of stuff that's already been announced. This is U.S. trying to control flow of U.S. resources and knowledge, intellectual property and funding into the development of AI and chips and semiconductors and things in China. So I think the industry already knew this was coming. They knew that this was the U.S. intent was to shut off flows into those particular sectors. So I think that's pretty limited. But I think if you start to really attack some of the U.S. listed Chinese names, Alibaba and Baidu, and these names are very heavily held in pension funds and other funds to provide exposure to the Chinese market. I think that would be unwise.
And it doesn't sound, Stephen, like we're necessarily going to go that far. So is this intermediate step one you think is warranted? I see at the same time today we have some lawmakers calling on the FCC to address potential threats in the Internet of Things from Chinese cellular modules.
Well, first of all, Kelly, keep in mind the Select Committee on China that Mike Gallagher is the chair of has no policy authority whatsoever. All they've got is a bully pulpit, and Gallagher is using that very effectively to moan and scream about China's what he calls techno-authoritarianism and is put enormous pressure on two companies, BlackRock and MSCI, to respond to a whole slew of questions and other forms of interrogation. But they can't make policy in this committee, and thank God for that.
So finally, then, Stephen, as people look at the Chinese stock market, which has been underperforming, we think about comments from Derek Scissors and others that, China has just simply not been a good investment, a good steward of anybody's capital. What would, do you think that's going to change or kind of where do we go if we continue down this path?
Well, I think ultimately the stock market will be driven by the fundamentals of the Chinese economy, which are terrible right now. The trade data that was released overnight, it's not just that exports were down, it's that imports were down much more sharply than expected, which indicates the weakened state of internal or domestic demand. China increasingly has more of a Japanese-like problem with an aging workforce and weak productivity and a debt-intensive response to these problems, which, borrows a page right out of Japan's script. So they've got very serious problems to address, and the policy actions that they seem to be taking right now do not appear to be forceful enough to address this problem.